All right, so let's start with what we would typically do in the case of when we start working with financial market data, right? So the first thing we typically do is we import a set of libraries. So I had referred to a certain set of libraries a little while back. So you do things like this: import NumPy as NP, import pandas as PD. So now, as I mentioned earlier, these libraries are used for processing the data. So NumPy is used for computation. Pandas is used for handling financial market data. So it kind of structures your data in the form of tables, which look like spreadsheets, but are a lot more powerful. And you have things like matplotlib, which is used for charting. Y-Finance, as I had mentioned earlier, is used for downloading of data via Yahoo Finance. So this is like, when you look at a Python program, this is like pretty standard stuff. So for instance, now if I want to download, let's say, the data for NVIDIA Corporation. So NVIDIA manufactures these, you can say, chips, graphics processing units, GPUs, which have become very popular these days. And it's quite an exciting company. It's largely a hardware company, networking, and I think chips. That's what they typically work with. So if you want to download it, so we could use, say, yf.download. If you were to do that, you can specify the ticker that we want. So in case of NVIDIA, it's NVDA. We want to specify, say, the start date for when we want this data. So let's say we want it from 1st Jan 2018 up to, say, 27th of September. So if you were to run this, voila, it's done, right? So at this stage, we've got our data. And if you want to see how this data looks, you'll see that we've got about 1,450 rows starting from 2nd of Jan, where the price was around, the close price was around 49.8. The adjusted close also was around 49.3. And eventually on 26th of September, it was about 419 or so, right? Notice the information that we have here. We have the open, high, low, close, adjusted close, and volume, right? So this is very typical of financial market data, where we have this each day for the last 5 odd years, 5-6 years, right? From start of 2018 until yesterday. Now, this is the way, we kind of fetch the data. So it saves us the time of going and downloading a file and opening it and all of that, right? Now, let's say you want some basic statistics of this. So there's a nifty little function called df. So firstly, df is the name we've given to this, what we call a data frame, which is the, like I said, it's kind of like Excel on steroids, the data frame itself. Sorry. And it's used for basically handling this data and adding columns and in general manipulating the data, because we are dealing with like many rows of this, right? All right, so let's start with something like a df.describe. If you want to run this, it gives you some details, right? It gives you the count, the mean, the standard deviation, the minimum value, and these give you the percentile values. So what is there at the 25th percentile, the 50th percentile, which is nothing but the median, the 75th percentile, and the max value, right? So for instance, if you were to look at, let's just look at the adjusted close column, right? For the sake of this session. So we have essentially 1,443 number of values for adjusted close. The mean over this entire period was 143. Standard deviation was 105. The minimum was about 31. And these are the percentile values, and the max being about 493. Right? So this gives you some details. If you want to do like a sanity check on your data, you can do like a df.info. So this incidentally also tells you, by the way, that this is a pandas data frame. Notice that it says data frame here, which is what it's called, this particular data type. It's also got some details on the columns that you have, the data type that it has, and the number of non-null values that it contains. So when I say non-null, it means your data is not corrupted. So so a null value would mean that for that specific day, for that specific row, some data was lost, right? So here you can see that all of them are non-null. Float essentially tells you that these can have fractional numbers. So you could have values like, and we know this, right? With stock prices, you can have fractional parts. You could have prices like 483.75 and so on. However, volume is stored as an int, which is nothing but an integer. So these are numbers that don't take fractional values. So it gives you some kind of idea on how these prices go. Now that you've downloaded this data, you may also want to save it if you'd like to, right? So if I want to save it, all I need to do is I could say df dot to underscore say CSV. So I want to save it as a CSV file. For those of us who don't know, CSV file is nothing but, I'd say it's like one of the flat data files that you have. It's comma separated values. So it kind of looks like a spreadsheet, but it's a lot less richer. So you don't have like columns with borders, and you don't have like certain values which are bold and so on. But nevertheless, it's a beautiful way to store the data because it can be shared across languages and across various systems. So CSV files are like I'd say a standard way to store data files. So I could, create say a CSV file called NVIDIA, and if I say df to CSV, and if I go to my working directory, here I have a file called NVIDIA, right? So if I double click on this, sorry, you can see that I have this entire data. Right? Okay, so this is like basically one way for us to download data as a CSV file for one specific stock, right? What if we want to work with multiple stock data? We want to work with multiple stocks. You can specify more stocks. So let me do one thing. Instead of typing this stuff, I was planning to type this stuff and walk you guys through it, but because of the paucity of time, I think I'm going to go to my after file. So I had an before and an after file, thinking we could walk through this stuff, but there's so much that I want to talk to you guys about that I think I should probably directly work with this. So I'd rather talk about what we're doing than start typing it, all right? Okay, so now if you want to work with multiple stock data, you can specify, say start, you can create variables like start date and end date. So we've created that here. And when we do the download, we specify all of the stocks that we want within these square brackets. So for instance, here I want NVIDIA, I want the firm Visa, whose ticker symbol is V. Then there's Caterpillar, which is a construction machinery firm, and PEP is Pepsi Cola. So if I want to download all of this stuff, I can do that. Okay, firstly I need to define it. Let's do this. So we'll import all the libraries and we will download it here. Great. Beautiful. So now you have the data for what, like 8 or 9 years of 4 firms and all their details, right? You have adjusted close, high, low, open, all of this stuff for all of these firms, right? So if you do like a dot head, you get those details. And if you do the first few rows, and if you do a dot tail, you get the last few rows, right? Now, suppose I just want to pull out the adjusted close prices because I want to work with that. I can create another data frame called adjusted close where I pull out the adjusted close prices. So now all the prices I have are for CAT, NVIDIA, Pepsi, and Visa, right? So I have all these details. Notice that I have about 2,200 rows of data. Right? So because it's over 8-9 years, again, I can do something like a describe, which we saw earlier. Now, suppose I want to plot this stuff, right? This is, I would say, like, whenever we start with quant analysis, we like to view, I would say, graphically look at our data because it starts telling us certain things and it starts giving us certain insights, which is hard to see when you just look at tables of numbers, right? So let's do that. Let's plot it. So here we've now plotted all 4 firms and their prices. Notice what we've done here. When we say dot plot, we specify that we want a grid, we specify the width of the line, and we specify the size of the figure that we want, right? So you have all 4 of them here, and it's kind of hard to compare because all of them have different starting points, right? Because obviously the prices of these 4 stocks, if you look at even like the data here, CAT started around $71, Nvidia started around $5, Pepsi started around 73, and Visa started around 62, and eventually they are at these levels 272, 425, and so on. So since their starting points and ending points are so vastly different, it's a little harder to see what's actually going on when you want to compare the 4 of them, right? So if you want to compare the 4 of them, one thing to do is why not make the starting point kind of common, right? So what we can then do is we can equalize the first number to be 1 for all of them, and every other number is proportionately changing with respect to that particular stock, right? So we take all of these prices. Basically what we do is, let's look at this. We take each of these. So let's talk about CAT. So every number in this column is being divided by 71.86. So the first number then becomes 1. This would then be 68 divided by 71. This would be 67 divided by 71, and so on. Similarly for Nvidia, each number is going to be divided by the very first one. So 4.83 divided by 4.83, 4.75 divided by 4.83, and so on. Same thing for Pepsi, same thing for Visa. So that way, the first number for all of them would be 1, and everything else would proportionately change, right? So we do that here. And so this looks quite nice. Your starting points are the same. So it's kind of like, a race, and we want to see what happens at the end of the race, right? In terms of how they did over these 8-9 years. So now that we know this works, let's create a data frame called common start data frame. And instead of keeping it as 1, let's say that all of them were at the price $100 at the start of 2015. And we want to know that or rephrase that, let's say I had invested $100 on each of these firms on 2nd of Jan 2015. Where would I be on 27th of September 2023? If I want the answer to that question, this should get me closer to that answer, right? So a $100 investment in CAT would have gotten me to say 379. $100 on Nvidia would have made me a millionaire, right? I would have been nearly at $9,000. For Pepsi, it would have been at 230, and for Visa, it would have been at about 370. We can do a plot of this. When you look at a plot like this, you get a better picture of what's happening. Now, clearly, Nvidia is like the breakout star, right? It's done phenomenally well compared to the other 3. But since that makes it harder for us to compare these 3 guys, we can only plot these 3 guys to at least get a sense of what's going on there, right? So notice what we are doing here. We are now specifying that, okay, I want to just look at CAT, PEP, and V. Right? So I run that. Notice again, when I say dot plot, I have a grid, I have line width, I have fixed size. I run it and gives me an idea of what's happening with these 3 guys, right? So it appears like Visa and CAT, if I had invested $100, would have gotten me somewhere near 375 or so, right? And comparatively, Pepsi hasn't done all that well, right, over those 8-9 years. So this is, again, some interesting analysis of, say, analyzing a group of stocks, right? We may want to drill down a little deeper on one specific stock. So let's say I want to do it with Nvidia. Let's just work with the adjusted close column. Oh, I forgot to run the first few sets. Let me run that. DF. Okay, DF is defined. So let's go back down. because the error said DA wasn't defined. Where are we? Okay, so now we should be good. All right, so now we have another data frame called NVDA, and with just the adjusted close prices. So I want to create a column with the returns that you get if you so a column called returns, where essentially what I'm doing is I want to know what the daily returns on, say, NVIDIA would have been. So when I say daily returns, I mean I buy at 49 and I sell at 52, right? So that would mean the return on, say, 3rd of Jan 2018. Similarly, I buy at 52.5 and sell at 52.8, right? Now this can be easily done with a function called percentage change, which I run here. I run that and I check. So now I have a new column, right, called returns, that gives me the daily returns for the entire column of nearly, we have like nearly 1500 rows of data. It calculates all of that. I have one NA or not a number here. So I drop that specific row to make things a little easier. And now I want to check and see the distribution of how my returns look over this period, right? So if you want to check for things like distribution, a histogram is a good place to start. So we essentially plot a histogram where we specify the number of bins we want, right? So we can even specify something like 10, but 10 is a little too coarse. So if you want a higher resolution image, you should probably do like 100. It gives you a nicer shape, gives you an idea that returns in general seem to be around 0%, right? Daily returns, with most returns being just a little over 0, right? So we can make that 100, even 1000. Okay, 1000 is too fine, so I think 100's better. So this gives you an idea of the histogram. You can also get a density plot, right? So a probability density plot where you do like something like a dot plot and you specify that you want a density plot this time. So it gives you a different, I'd say, view of the same data, right? So it gives you, so this is essentially like plotting a curve around this, right? So what our eyes were doing implicitly is being done explicitly here when you get a density plot going, right? Okay. So we've spent some time now on looking at single stock, multi-stock, and doing some preliminary data analysis, right? So now what I want to do is I want to go and jump into a strategy in terms of what you can do using Python to run a strategy, right? So we are going to use a very simple strategy. It's called a moving average crossover. So here what we'll do is we are going to compute these moving averages. So you compute the average price of a stock over, say, the last few days, right? In our case, we are going to look at computing the price over, say, 45 days or over, say, 90 days. And every time the short moving average crosses the longer moving average, we are going to buy. The polarity is exactly the opposite. We are going to go short. That is, we are going to sell, right? Now, this is a pretty, I'd say, standard strategy that is used in the markets. It's referred to as the hello world of quant strategies because this is one of the first things that people start experimenting with when they want to start working with systematic trading or quant trading, right? So we are going to do that here. So we create two variables. It's called S, shorter look back period, and longer look back period, referring to 45 days and 90 days. And we compute the rolling means or the moving averages. So computing moving averages is done via the rolling mean function in Python and Pandas. So that's what we've done here. We're computing them. And then we want to plot them all to see how they look, right? So what you see on your screen here is the price of NVIDIA over these last 5-6 years, and these orange and green lines, which show you the shorter look back and the longer look back, right? So what we want to do is every time these lines cross, we want to take a position, right? We want to go either long or we want to go short. So really speaking, the times when we do it is going to be, say, here, it's going to happen around here, it's going to happen around here, and so on, right? Wherever you see these crosses, is where we are going to start taking positions. And like I mentioned earlier, the position we take is either we go long or we go short, right? So when I say go long, it means we are buying the asset. And when I say go short, it means we sell the asset, right? This is not the same as selling something we own. It is selling selling before we buy, right? It's a specific concept that happens in the markets. You can look it up, online, and see what the meaning of short selling is, where you are essentially reversing the order in which a buy and a sell happens. So rather than buying first and selling later, you sell first and then you buy back what you sold, right? Okay. So what we do here is we create a column called position, where we denote one for going long, that is buying, and we denote going short or selling as -1, right? So if the shorter look back is greater than longer look back, we are going to encode that as 1. Else, we are going to encode it as -1. So that's what we do here. We drop the NAs to make our life a little easier. And when we now take a look at the data frame, you'll see all these new columns that we've created, right? The shorter look back, the longer look back, as well as the positions vector that we've created. Now, at this stage, it would be interesting to plot all of these together to see what's going on, right? So what we are doing here is we are plotting the adjusted close, the shorter look back, and the longer look back, which we had anyways done earlier, which is here. But additionally, we also want to plot the position column. And since the position column only takes +1 and -1, we will have a different y-axis for it. So you'll have a y-axis on the right side, which is going to track what's happening to the position, right? So let's do this plot. So when you look at this plot, notice that the left side, the left y-axis is for the prices, right? For adjusted close, shorter look back, longer look back. And the y-axis on the right is for monitoring what is happening with the +1s and -1s, right? So you can see that it was -1 for a little while in 2018. Then it was +1 for like what appears to be about a year. Then it was -1 again, +1 again, -1 again, and so on, right? That's what is happening. So in terms of the positions we took over the years, right? Now, at this stage, if you want to compute the returns of what your strategy would have given you, as opposed to a passive investment strategy where you just bought the NVIDIA stock, say in 2018, and you were sitting pretty, right? So this is what we call a passive investment approach, where we just buy a stock and we hold on to it. We call it buy and hold, right? So we create a column called buy and hold returns, BNH_returns, and we compute the log returns. So it's taken by computing the log price of today's. So today's price divided by yesterday's price, we take the log of that, right, to compute the returns. And for the strategy returns, we need to essentially take these buy and hold and multiply it by the position vector, right? So the position takes care of the fact that it tells us when we are. It will multiply the right number based on whether it's +1 or -1, because we may be either long or short, right? So these two new columns are giving you the returns of the buy and hold as well as the strategy, right? So over the years, what is happening is, as time rolls by, what you can see here is that the blue line gives you buy and hold. So you started off here, and then you make a little bit of returns, and there was a period when you notionally were below 50% of what you had invested, right? The returns were really low because the firm did go through some really rough times if you invested around here. And then around 2020 it picked up, and then since then it's kind of had a really good run, right, until say about 22, and it went down again, and then it's again been going up, right? That's what a buy and hold has essentially done. Whereas your strategy, in some sense, has managed to go over this period quite well, right? So you managed to take the right kind of positions when the firm went through some really rough times, because those moving averages seem to have worked out well. Around here, the strategy has actually cost you a little bit, right? So the firm seemed to be doing well, but the strategy has gotten you take positions where you've made lesser returns than you otherwise would have. But nevertheless, you've still been on the positive side more than the negative side. I mean, overall, you've still made money. And again, this period, the strategy seems to have done well, right? So overall, it looks like the strategy has done better than a buy and hold, right? So when we do take positions in a strategy, that is the least we expect, right? Because we are investing our time, our effort to craft a strategy, and at the very least, we hope that it does better than a passive investment strategy, right? I'm not saying this is the only way to measure the performance of a strategy, but this is, I'd say, like one of the first steps we do in order to evaluate whether a strategy is doing well or not, comparing it to a buy and hold. Okay, so again, we can just do a DF to take a look at all the new columns we've created. So we've created all of this stuff. If you want to check what the actual returns were over this period, this tells you that the buy and hold would have fetched you returns. And by the way, these are log returns, right? They are not the typical numbers that we're used to, the kind of returns that we read in our investment books and investment return portfolios that our money managers may be giving us. So if you want to get a hold of that number, you need to kind of exponentiate these numbers to get that value, right? So which is what we've done here. So if you want to know how much would an initial capital of $100 from day one accrue to at the end of this time period, if you want to compare, say, a buy and hold with a strategy returns, what you should do is you kind of exponentiate this number, and we multiply it by 100 because we want to compare it to $100. We want to take a round figure. So if you were to run this, what it essentially tells you is $100 investment in NVIDIA back then would mean you're sitting on a pretty sum of $660 today. And if you had followed through with your strategy, you would have made like more than $1,000, right? So your strategy has clearly outperformed the buy and hold approach. So this entire thing that we went through now is to give you like a glimpse of what backtesting looks like when we start working with historical data and we want to kind of see what would have happened if I had taken those positions based on certain rules that I created, right? So as the name suggests, backtesting means we want to go back in time to see what would have happened, right? So I would say this is like one of the initial steps when we work with strategies and start doing our analysis.